welcome to this weekend's edition of Taking Stock. This is a show where we prepare you for the coming week and discuss all that took place in the week gone by. I'm Sonia and with me is Anuj. Anuj, good week for the market. I mean, the Sensex and the Nifty went up 2%. This is on top of the 3% rally that we saw last week. So all in all, not bad at all.
Not bad at all, Sonia. And I think two things that stood out this week. One was that the broader market was already at lifetime high. The mid-cap index on Friday actually hit a new all-time high and closed at that. The BSE small-cap index is already there. You saw BSE small-cap index rallying 6%. The Nifty Junior was up about 4%. Beta is coming back in the market. The real estate index was up close to 6%. If you were to exclude just 3 or 4 stocks, ICICI Bank, HDFC Bank, and maybe Axis Bank, the private sector banks, this market is practically at an all-time high because the Bank Nifty underperformed, but the Bank Nifty is 75% private banks. PSU banks did remarkably well this week, PNB, SBI. So all in all, a good week. Practically, the market is at an all-time high. It's just, as I said, just 3 or 4 stocks that are not leading the market. And the other thing that stood out this week was Reliance. That stock moved, and that stock is moving because it's expecting blockbuster earnings from Reliance company. So clearly, the market's focus is on earnings now, and the market would want to reward those companies which will come out with good earnings even before the earnings season starts. And the broader market is at an all-time high. So all things looking good. It's just for practical purposes, the Nifty still has to go back to all-time high. And in that, I think there would be some headwinds because the banks, the private sector banks, may still continue to underperform.
No, indeed, you know, high beta, low beta, everything went up this week. Not just Reliance, which was up about 8%. Coal India came out of the blue, up almost 7%. And in the broader markets, HDIL was up more than 30%. So traders or investors, there's been something in this market for everyone.
And I think pharma took a bit of a backseat in the last 2 days. So again, telling you that maybe risk is coming back on the table.
All right, on that note, let's discuss all these macro and micro cues with our first guest in the show. Binay Chandgotia of Principal Global Investors Hong Kong joins us now to talk about that. Binay, hi, welcome to the show and thank you for joining us. First up, what's your view on India post the Moody's upgrade that we had last week on the outlook of India? How high is the probability now of a ratings upgrade in the next 12 to 18 months?
Yeah, the overall sense we get on the Moody's upgrade is that it's an affirmation of the policies that the government has taken over the past 12 months. Having said that, there is a lot of road to travel. The upgrade itself will not have a major impact on the markets because it's just a change of the outlook, right? And they're saying that they'll take about 12 to 18 months. If the growth trajectory, if the inflation management trajectory, if the fiscal path is solid, then you might see an upgrade from them at the end of a 12 to 18 month period. But yes, it does reaffirm, as I said earlier, what the government's trying to achieve, which is a better fiscal policy, better monetary management, and of course, a very critical thing is inflation management, because that's often been the problem for the Indian economy in the past.
Binay, hi. As a portfolio manager then who has invested into India for so many years, how are you tactically positioned in terms of regional allocation and in terms of India versus China? Do you like China better than India right now?
We are positive in India. We have been positive in India for the past few months. Currently, in terms of regional allocations, we believe that maybe China tactically offers a better set of short-term return dynamics. But fundamentally, we remain very positive in India, and we believe in India as a long-term story.
Well, just to continue that discussion then, recently we've seen offshore markets in China rally considerably. Hong Kong was up so much last week. What are the average returns that investors should expect from China versus India by the end of 2015, you think?
Well, as I said earlier, short term, the reason why China is going up is simply because of the fact that they are losing the liquidity taps. They had a big announcement in China a few days back where they're going to allow domestic onshore fund managers to invest into the offshore market, and therefore you've seen the offshore markets rally. But clearly, some of the movements we're seeing in China this year are a catch-up of the lagged performance of the China equity indices. India significantly outperformed in 2014, and China is beginning to do well this year. On a longer-term fundamental growth-oriented basis, we think India presents a better structural story. Having said that, Chinese GDP growth, which was at 7% last year, the target from NPC is also 7%. We think it will be lower than that, more closer to 6% than to 7%. Now, having said that, valuations are very cheap in China, right? In India, they were already capturing in a lot of the growth expectations. In China, they were not capturing in any growth expectations. So there's a readjustment process going on right now. On a short-term basis, China could outperform for this quarter, but we ultimately think that, towards the end of the year, India should do okay.
So if you are more bullish on Indian equities versus debt, what kind of returns do you see in the next 2 years, and what should the allocation be between sectors?
Yeah, that's an interesting question. How much returns you will get from equities is going to be a function of the progressive policy steps that you get, and of course it's also going to be a function of what happens in the global equity markets. Our sense is that so far Indian earnings have disappointed. The last 2 quarters were bad. The coming quarter is going to be we probably get a negative earnings growth for this quarter if you include energy stocks and material stocks. But we are at a point where the bottom-up earnings environment needs to improve. So let's assume that India's GDP grows at about 7.5 to 8% in real terms, which results in a nominal GDP growth of about 13 to 14%. And there is a sense that after the adjustment for inventory write-offs is over, the earnings could go a little higher than that, which means that if India grows at about 15% compounded for the next 2 or 3 years, the market should return that much, because valuations as compared to historical trends are pretty much in line. They're not too expensive, they're not too cheap, obviously. So we think India could deliver that kind of a return going forward the next 2 years.
Okay, Binay, we hit earnings season next week. Last quarter was quite abysmal. In fact, third quarter revenue growth was just about 8 to 9%, all-time low. What's the prognosis for fourth quarter?
Yes, that's an interesting question. Our sense is this quarter is going to be as good or as bad as the last quarter, because you still had disinflationary tailwinds from the cyclical sectors, as in product prices coming down. And you will still have some more of inventory write-offs from people carrying inventories which are built at much higher cost levels. So our sense is you could get a revenue growth of 2 to 3%. You'll probably get a profit growth which is either flat or slightly negative on a broad market basis. The recovery has to start showing from the first quarter of next year. We don't think you will realize the full extent of a 14 to 15% earnings growth expectations for next year immediately. It will be built up gradually. But there have to be some signs that we are leaving behind the 2 quarters of flat to negative earnings growth. So first quarter for next year is going to be very important. There are also signs, that some of the commodity price disinflation which hit the global economy into the fourth quarter of last year and the first quarter of this year, some of that is easing off, as in prices aren't dropping any further, which should be good from a corporate bottom line perspective as well. It gives more stability, and it ensures, it creates an environment where you don't have to write off the value of your inventories any further.
All right, Binay, we'll leave it at that. Thanks so much for joining us. You have a good weekend. We hope to see you in India sometime soon to discuss more on the markets and on the macros. But as we slip into a break, let's listen into some market opinion that we heard through the course of the week. We'll come back.
We've really come out of some very difficult times. And I think the foundation of this bull market has been laid about 18 months back, where we kind of went in with aggressive policy response. I clearly believe India is very fortunate that we have, of course, our 2 very big economic drivers which continuously play out irrespective of whichever government is in power, which is clearly demographics and urbanization. These 2 are very big drivers. But clearly the growth accelerators, what India really needs are not just structural growth enablers or drivers, but we need growth accelerators.
India looks to us like one of the best investments. We are overweight on India in our Asia strategy. And I can see 2 reasons. The first reason is actually really just the fundamentals. Before we even start talking about reforms, India has incidentally also over the last couple of years already consistently given better earnings growth than Asia overall, and we expect that to continue. India is no longer really cheap. India has a somewhat demanding valuation in the meantime. I think they can keep it up. But what has to happen now is really the legislation of things like land acquisition bill and GST has to be successful. I think that can sustain the valuation.
I think the market now can be driven by the earnings growth. We have seen last year PE ratio expanding from 12 times to 16.5 times and earnings expanding by about 5 to 6%. Clearly, the scope for PE ratio expansion is limited. The earnings growth will be the biggest driver. Clearly, we see in some of the quality stocks where lack of supply has kind of kept valuations and prices at elevated levels. I don't think so this trend can sustain for a long period of time, so it is very difficult to predict when it will end.